Hi friends, welcome to our channel. If you are watching first time, please subscribe. Today we are going to discuss about the most important concept in IndAS system, that is asset acquired in exchange of non-monetary items. What is non-monetary item? So without cash transactions, without any commercial benefit, if you transfer from asset from A entity to B entity, that will become a non-monetary asset. Say suppose A entity, B entity. You just acquired, you have P1 plant 1, B has P2. Now these A and B, these A and B guys are transferred. See, P transferred to A and P1 transferred to B. In these situations, how to account as per IndAS 16 is the question here. So now we are going to discuss about this. Please subscribe to our channel if you want to more interested videos like this. See, in this situation, if particularly if assets are acquired, if assets are acquired, okay. If assets are acquired a non-monetary asset, you need to see the order. First, there is a case one and case two. In case one, you have commercial substance. In case two, you don't have commercial substance. What is commercial substance? Commercial substance means there should be a gain or loss or something, you should, as for business benefit, and you on your own take that decision. But lack of commercial substance means, in general, government acquisitions or road windings. In these situations, the government guys will give another place to you. Say suppose you have plant and machinery on this, they acquired this and move from here to another place. No effect of your business, no customer effects, and no transit effect. There is no single effect from year to year you have shifted this. Has there is no commercial substance here in these situations. Generally government acquisitions and road windings and other compulsory acquisitions or insurance claims, all these kinds of situations will not cover here. So you can see first what is the commercial substance in those situations. If you have commercial substance, in this case how to account. Thereas, say suppose A1 is our entity, A2 is another guy who are going to shift this. He has plant 1, he has plant 2. Now we are going to exchange these plant 1 plant 2 between these A1 and A2. See, the fair value of plant is 1 lakh, the fair value of plant 2 is 1,20,000. The book value of plant, it is net value of depreciation. The book value of plant A is 80,000. The book value of plant 2B is 90,000. So now we have these two values. This is the carrying value or book value, you can say. Now they want to adjust these transactions. Now P1 and P2 add an agreement saying that they will give another 10,000. P1 will give to P2 for transfer of this P2 to A1 and P1 to A2. So they exchanged property, plant and equipment, for 10,000. So we cannot account property, plant, equipment 10,000 debit to creditor A2 10,000. So this is wrong accounting treatment, right? So now as for IndAS, we need to see what it is telling. In these situations, here you have all available data. Case 1. You have fair value of plant and machinery, it is old asset. This you are giving, right? This is new asset. So you have fair value of old asset, fair value of new asset, and carrying value of old asset. This is 1. The 1, and this is 2, and this is 3. So you have available of 3 data: fair value of old plus fair value of new and carrying value of old asset. These three prices as required to adjust the accounting. So first preference should be fair value of old asset. If you have fair value of old asset, no, what is the fair value of old asset? 1 lakh plus or minus cash adjustment. Apart from this 1 lakh, you are going to pay 10,000 also. It is plus 10k. So your value is 1 lakh 10,000. And the second case, fair value. This see, this is the first case, and then the second case is you have only fair value of new asset and carrying value of old asset. In these situations, first preference should be this, but this is not available here. So old asset fair value is not available here. So you can't take that. Now you have available of fair value of new asset and fair carrying value of old asset. In these situations, the preference should be this, like fair value of new asset. What is the fair value of new asset? 1,20,000. So the new asset value is 1,20,000. Did you receive money or did you pay money? So you receive money. So adjustment plus 10k. So your value of the asset is 1,30,000. The third case, old fair value and new fair values both are not available. You have only carrying value of old asset. In these situations, you don't have available of this and this. You have only available of carrying value. The same formula, carrying value of old asset plus or minus. You are going to pay or receive, pay 10,000 plus 10,000 extra you are going to pay to acquire that asset. This is called 90,000. This is the value of your PP2. I mean, this one. This you received from them, right? So this is the value of PP2 in A books. This is how you account here. I hope you understand these logics. What is so the preference should be based on data available. So you need to understand this formula. What is the data available? First, we give preference fair value of old asset plus or minus cash adjustment. First preference. The second preference is fair value of new asset acquired or plus or minus cash adjustment. And the third point is fair value of, carrying value of old asset plus or minus cash adjustment. So this is the preference, the first preference and the second preference and the third preference. Based on the data available with you, you need to take the values. So I hope you understand this concept. Next, I will explain the core second concept. So second concept. What is the second concept? Lack of commercial substance. Lack of commercial substance. In these situations, how do you account? How do you account? In these situations, how do you account? See, in this situation also, you need to account old value to, say, suppose you have one planted machinery here and the government acquired this planted machinery and they intentionally want to shift to here. In this situation, the carrying value, the fair value and the fair value of old is available, fair value of new is available, and carrying value of existing asset is available. Everything is available, but you cannot consider all these two. You have, there is no commercial substances, so there is no money exchanges and something else. You just need to take the direct carrying value of old asset. So there is a direct third preference here, carrying value of old asset, carrying value of old asset plus or minus cash adjustment, if any. Generally cash adjustment is not there, but for formula sake I am asking. This is the core concept about the asset acquired in exchange of non-monetary asset. Please subscribe our channel for this kind of more interested videos. I hope you understand. Guys, this is our channel. In this channel we discuss about all core concepts of NDAS and GST directors and everything. All CA concepts will explain in a easy manner and easy way to understand it to the students. So I hope you understand. If you think we are going to put efforts on this concept, please subscribe our channel. Please like if you like this video. Thank you.